Welcome back to this new live stream here on the channel, everyone. Today, we will be talking about the FOMC meeting. And yes, today will be a super important day because yes, we do know the Federal Reserve is going to do another 25 basis points probably today. Maybe they're going to do more, maybe they're going to do less, but it is a 90% chance that they're going to do 25 basis points. But more importantly, today we will be watching to the FOMC meeting and we will see what Jerome Powell will be doing. And in this exact chart in front of you, I can tell you already is the historical data about all the previous FOMC meetings. And you can see one thing clearly straight away. There is always a lot of volatility on the day itself of the meeting, like you can see from previous occasions. But more importantly, there has always been a big move for Bitcoin after the meeting. Here as well, after the meeting we saw the big move. Here as well, after the meeting we saw the big move. And here as well. So what are we expecting right now? Because this time around, it will be indeed different. Because if we're going to be looking at the probabilities for the FOMC and the Federal Reserve in general, we do know that this is probably the last interest rate hike of this cycle. So it's going to be super important to be watching this stream, watching today's stream, because yes, we will be going over this. We will see what Jerome Powell has got to say. But more importantly, before we get the interest rate hike decision in exactly 12 minutes from now on, and the meeting will start in 42 minutes from now on, let me start to talk about the market and about what we're currently seeing here for the imminent short term for Bitcoin. Because like we do know, Bitcoin had a massive break towards the downside, and I will give my quick analysis on the price action of Bitcoin, but more importantly, I will do some analysis on the open interest that we can currently see in the market. Because yes, there is something happening in the market. You can see that open interest is still quite significantly high. We can see that, of course, on the CoinGlass data. But more importantly, we can start to see that the funding rates are actually starting to turn negative. While, in fact, on this drop towards the downside for Bitcoin, the open interest actually increased. So we can see Bitcoin had to flush towards the downside, and what happened on this move towards the downside, that is what I'm trying to translate here to everyone out there, is that actually more short orders got opened. And that is actually making me quite bullish that many short orders entered the market while Bitcoin was actually going lower. And at the point that these shorts were exiting the markets, you can see here open interest goes lower and Bitcoin moves up. So there are many short positions right now in the market, and they're actually loading up on this region right here. What makes it for me very interesting to see that the funding rates is turning negative right now. So that is actually making me quite excited for the imminent short term to potentially see a short squeeze happen on the price action of Bitcoin. But one thing is for sure, and one thing that everyone needs to know here on the market, that today anything could happen. And I personally especially expect that really the volatility is going to hit the markets once Jerome Powell is going to talk. And to be very honest, since the markets, and this is the S&P, let me go to the S&P. This is the S&P 500 and the orange line is Bitcoin. But since the S&P 500 has continued to rise towards the upside ever since 2023 started, I am probably expecting that Jerome Powell is going to try to talk the markets down. He's going to be pushing the markets down again, because if we're looking at the FOMC meetings and at the US stock market, we can see that in the last meeting, the US stock market went up, but after that went down. Then the meeting before that, we had a big dump towards the downside, but Bitcoin moved up. But basically on the day itself, usually Bitcoin tends to be dropping, like you can see here. Usually on the day itself, Bitcoin tends to be dumping, but the last time Bitcoin went up. So let's see what's going to be happening this time around. But like you can clearly see from this indicator, anything can happen today here. So that is also what I'm trying to say here. Yes, open interest is indeed increasing, and it makes it very good for the long positions in the market, and probably short squeeze is going to be imminent, but still anything could happen. So let me quickly talk about the market before talking about the FOMC, because we will be talking about that enough in a moment from now on. Looking at Bitcoin, we're currently creating a small little bear flag. This is, of course, a bearish bias pattern, and if Bitcoin breaks that upper sloping support line, I personally think we could come down to 28.8k, and that will be, of course, mean that Bitcoin is going to be seeing another move towards the downside, and that would, of course, also mean that Bitcoin potentially is going to create a bullish divergence on the RSI. So I'm going to keep my eyes wide open on that, but if Bitcoin breaks below the support here, this upper sloping support line right here, my price target is not going to be all the way down to $25,000, what some people are saying here on the internet, but my price target is going to be the low over here. What I will be expecting is probably a small liquidity grab and then a pushback towards the upside. So that is my scenario if Bitcoin is going to be moving down, and I've already set up some orders on 28.8k to exactly grab this liquidity right here. So let's see if that's going to be happening, and let's see if we're going to get filled up on that position over there. Looking at my analysis here on the 1 hour time frame, we can currently clearly see Bitcoin is creating these very important horizontal levels. And you can clearly see this was the top side of the region. We got rejected by it right here. We moved down. Then I talked about this lower region right here. The point we basically broke this support, we straight away moved towards the downside. And right now we're entering a new range. And if we do break outside of this range here on the top side, like you can currently see, we're seeing already gigantic rejections from off this level. The 29.3k is the level to break. If we break above 29.3k, what I will be expecting is that Bitcoin is going to be pushing back up here to 29.7. But 29.7 was the previous resistance here in the market right here. And I will be expecting that 29.7k is going to be once again flipping into resistance. So that is going to be probably the level where we're going to see a rejection from. However, if we break back in towards this region, we will probably once again see more consolidation between the top side right here. So that is the simple game plan. And of course, if Bitcoin breaks below this $29,000 support, next support is going to be $28,000. And if we really break below $28,000, this green line right here, sorry, this is not green. The green line right here, if we break below that level, $28,000 is going to be next for Bitcoin. So that is my horizontal play. That's how I will be looking at Bitcoin. I'm going to be very quick because in 5 minutes, we're going to get the official data about what the interest rate is going to be here. And I mean, there are no surprises. I'm going to do my analysis after the interest rates come out as well. So make sure to stick in the stream. We've got a lot of things to talk about right now because in exactly 35 minutes from now on, we're going to see Jerome Powell starting to talk. And that will cause massive market volatility. That is one thing I can guarantee you. So looking at the probabilities, we're expecting a 25 basis point is like a 97% chance it's going to be happening. So it's going to be very likely it's going to be happening. And if something else happens, we're probably going to see massive volatility in the markets. But if this just happens, there's probably not going to be a lot of things happening. So don't expect a lot of volatility to happen in the coming 6 minutes, but especially in 30 to 40 minutes from now on, that is when I'm expecting the volatility is really going to pick up. So looking at Bitcoin right now, you can see we broke below the consolidation range where Bitcoin traded in for an approximately 32 days. And more importantly, let me get the right chart. While we were breaking down of this region, we were actually seeing the volume decrease. So usually once you see a breakdown or a breakout, you tend to see the volume spike. But this time around, volume keeps decreasing. So there is not a lot of activity in the market right now. And that is what I find very interesting. The activity is so low. And Bitcoin is breaking down. It's breaking below its very critical support. So this could potentially be a fake out since the volume is so low. And that could mean that this is, of course, potential manipulation in the market. So yes, let's see what is going to be happening. But of course, buyers are also exhausted. Sellers are also exhausted. And we look to just be very boring for Bitcoin. And you can clearly see it. The reason why we're so boring is the Bollinger Bands is also so super tight. There's just not a lot of stuff happening in the market right now. And to be very clear, Bitcoin is currently as tight as the beginning of 2023, what was a super tight point in the Bollinger Bands. And to be very clear, if you're going to be zooming out on the daily time frame, the last time we were so tight on the Bollinger Bands was all the way back in 2016. You can't even see it right now, but you can see it right here. 2016 was the last time we were so tight on the Bollinger Band. So you can't imagine on how low the volatility currently is here on the market. It is super low. It's super crazy low. So make sure to take that in account. Bitcoin may be boring. People are maybe losing attention, but that is what they want. They want you to lose your attention on the market. Well, in fact, this is the most important time to actually pay attention. So at the same time, we can currently see Bitcoin is creating new patterns. And looking at this pattern, Bitcoin is actually right now creating a new pattern called a falling wedge. And a falling wedge is a typical bullish bias pattern on the market. And this one could be potentially breaking down, but there's an 80% chance that it's going to be breaking up. But if it breaks down here, let me straight away give you my target. So if Bitcoin breaks below this very important level of support of this a falling wedge pattern, my next target is going to be this green line right here. And let me make it white. Let me make a clear box on top of it. So this is going to be my support box. If Bitcoin breaks below the support, the downward sloping support of the falling wedge, next target, $28,000. If Bitcoin breaks below this upper sloping support line right here, next target 28.8k. If it breaks below this green line right here, next target $28,000. So I'm approaching Bitcoin from several time frames, and it's a very clear approach. But if Bitcoin manages to be breaking this downtrend right here, it could start to increase very quickly, just like we broke out of this falling wedge right here. And I talked about it as well on the channel. Falling wedges tend to be breaking out towards the upside 80% of the times. And yes, this one also broke towards the upside, and you can clearly see Bitcoin once again reach its price target of $31,000, what was of course the price target in this case of the falling wedge pattern. So yes, we're creating another one, and this could be quite bullish for the market in general. So I'm going to talk more about this in a second from now on, but to be very clear, let me get my timer right here. Boom, 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 boom. In exactly 2 minutes from now on, guys, we're going to get the data that is probably going to cause massive volatility. So I'm going to set my chart on the imminent short term. So this is the 1 hour time frame. I don't expect much volatility is going to hit the markets, but I do expect some volatility is going to hit the markets. We're expecting 25 basis points to hit the. We're expecting to see 25 basis points in interest rate hike. If that is going to be happening, it's going to be playing out exactly as predicted. I am not really predicting that Bitcoin is going to go up or down right now because it's super hard to say, but I will be looking at my horizontals. And if we do break above any of these levels, that is going to be the confirmation about where we should be looking at. So yes, let me also draw this real quickly. We're currently 2 minutes out here before we're going to see that next move going to be happening for Bitcoin. You can see Bitcoin clearly consolidating and squeezing up again here. So we're really getting ready for next move here, especially with the FOMC meeting. And I don't know if new people are joining in the stream right now here, but there's a big misconception. Bitcoin will not really move big here in the coming 2 minutes, but especially once Jerome Powell is going to start talking. So make sure to stick in the stream, because in exactly 31 minutes from now on, Jerome Powell is going to sit on the chair and he's going to talk about the markets and about the US economy, and he's probably going to say it's very resilient, but let's see what he's going to be saying. But his saying will have massive effects on the market. So Bitcoin is starting to get volatile exactly 30 seconds out, guys, before we're going to get the data. And if you're watching the stream, you will be the first one to know here what the data is going to be here. So I'm going to open it up right now on my phone, and I'm going to be looking about the data here. So get ready. We're 18 seconds out before we will know it. Yeah, let's go out with a bang. Patterns. Yeah. Yeah, better. Yeah, usually Bitcoin patterns tend to repeat. So 1 more second, guys, and we will know what the interest rate is. It's going to be probably 25 basis points like we've been expecting. Let me quickly see. It's not loading. It's not loading. It's 25 basis points. Let me confirm. Yeah, 25 basis points, guys. So just like expected, 25 basis points interest rate hike. Bitcoin is not really moving big here. You can see currently the Fed funds rates, it's sitting around 5.5%. Exactly like we've been predicting. So let me quickly reload the sites. Boom. So it's 25 basis points, exactly like predicted. And like I said before, there's not going to be any volatility probably hit the markets, because it was so likely that this was going to be the outcome that we were not going to be expecting to see so much volatility. Literally 97% of the market priced it in, and that is the reason why we're also not seeing a gigantic breakout whatsoever. However, in 30 minutes from now on, I'm going to show you guys the Federal Reserve that is going to go live, and I've already got it prepared. So, oh, sorry, now you probably heard in the background. So in approximately 29 minutes, we're going to be watching to the FOMC meeting, and that is the point where volatility is going to hit the market. So in the meantime, I'm going to give you guys some more analysis on Bitcoin on the short term to talk about where we're really going to be heading towards. And then in a minute from now on, I'm going to talk about some on-chain stuff, and I'm also going to talk about maybe some questions you have got in the chat, and I could be maybe answering them. So quickly looking at the daily range for Bitcoin, looking about where we're currently standing. So zooming out real quickly, looking at the most important levels for Bitcoin. So looking at this chart, we can currently clearly see what the next story is for Bitcoin. So what is the resistance to break? It is not exactly this level. It has to be a little bit higher. It is the 31.8k, the level where we got rejected from here on the top side, and also the range high / daily high on the market back in May 2022. So you can see that if we do break above that level, what is the next resistance? Is going to be 35k here. And 35k is the range low in the market right here. And that is, of course, the next level we will be looking at. But currently, we actually broke below this imminent short-term support right here. So let me zoom in a little bit here to make it a little bit more clear for everyone watching, maybe on a small phone. You can currently see Bitcoin broke below this very important support right here on the daily time frame, and to be very clear, the next big daily support for Bitcoin is $28,000. Do we necessarily have to go down to $28,000? No, because there's several support levels between us, and you can currently also see that we're creating a falling wedge, and we're finding some downward sloping support right here. So we don't necessarily have to go down to $28,000. However, if we break below this downward sloping support right here, I will be expecting it's going to be happening. And if we do not manage to hold $28,000, yeah, I'm sorry, but then really the next support is going to be 25.7k, and if we break below that, it's going to be 24.8k, and if we break below the range low in the market right here, so if we turn around this low right here, so Bitcoin comes down, breaks below this low right here, I personally think we're going to go lower, and potentially $18,000 is then going to be in the next scenario, because then if Bitcoin breaks the range low, we're probably going to go in a bigger, larger bearish trend. So that is of course not a thing I want to be seeing, but that's of course a scenario I will have in mind if it does decide to be happening. So those are the key levels of support and resistance. Looking at Bitcoin in terms of its volatility, it's still extremely low. Looking at the super important level for Bitcoin on the 3-day time frame, you can currently see, you can also approach from the 1-day time frame or whatever time frame. You can even do it on the 1-hour time frame, but you can clearly see Bitcoin is creating somewhat of a legendary support line. We basically every single time once we retest this level, we tend to be bouncing from it significantly, and like you can see, Bitcoin so far has bounced from off this level 3 times in a row. If we're going to see another retest of this level, we could see once again another gigantic move for Bitcoin getting initiated. So I'm going to keep my eyes wide open on this level. If we do see a retest on it, it could mean that we are going to see probably a huge reaction on the price action of Bitcoin. So that is what I will be looking at. At the same time, Bitcoin not moving so big yet so far. We can currently still see it's super boring at the imminent short term. Then looking at the cup and handle pattern for Bitcoin, resistance to break is of course $31,000 on that 3-day time frame. Also right here we can see we're creating somewhat of a new squeeze pattern, looking to be breaking anytime soon, but the resistance to break is just that top side, and then we could be having a massive breakout. Because yes, to be very honest, I could be also approach the handle completely different. I could approach it completely different, and to be very honest, it's not a stupid approach if I approach it like this. So Bitcoin is right now creating just that next handle on the right side. The handle is currently literally getting created. A cup and handle is getting created on Bitcoin, but this takes a lot of time. Bitcoin doesn't break out overnight. So make sure to be very patient. The patient investor will always win. So looking at the bigger perspective, you can see also in the last bear market, there was just one gigantic range that we needed to be breaking above of. And in that case, it was the 11.6K. And this time around, it's $32,000. I think really this is the resistance break. If we break above this level, that is really the point where the next bull run could get reinitiated, or we are basically have cleared the main important resistance. So I will be keeping my eyes wide open on this level. As soon as we do manage to break above it, that is the point where we could start to see Bitcoin go a little bit more exponential. Quickly looking at the imminent short term, we can see that of course Bitcoin is moving up and down here. Looking at the open interest, we can see that the open interest actually increased. And what is also very important to know here, so this is basically today. I'm looking at the 5-minute time frame. So in the approximately last 4 hours, a lot of things have changed in the market. Because in the last 4 hours, we saw an approximately increase of about 2% in open interest, and that's quite a lot. And while that happened, the funding rates are turning negative. So that means that a lot of shorts are getting loaded on the markets. And if shorts get loaded up, we could potentially see a short squeeze happening later today on that Federal Reserve meeting. So get ready for that. I personally think there's going to be a lot of volatility. I would love to see the open interest go even a little bit higher, because that would make an even more exciting meeting. But currently we can see a lot of shorts are getting loaded up, and on the move down here you can see that some shorts got closed, and right now also open interest is going lower while Bitcoin is going up, what means that probably short positions are exiting the markets, because yes, we can see that funding is extremely negative right now. So yeah, makes it a very interesting case. I'm going to keep monitoring this on the imminent short term as well. And then a quick update, guys. I will be talking about the gigantic opportunity we currently have in the market, because looking at Bitcoin, looking at this bigger perspective, It is absolutely crazy. It is absolutely crazy what we're currently can see here, because let me quickly make it a little bit bigger here. Guys, we can currently see that we're in one of the largest accumulation ranges we've ever seen. And this is not updated for an approximately 2 weeks right now here, this chart. So it is old data from 10 days ago here. But you can see that on the 16.5K, approximately 640,000 Bitcoin got accumulated. You can see on the approximately, what was it, 3.4K, so the bear market bottom of 2018, 18, 19. We saw on approximately 350,000 Bitcoin getting accumulated. And you can see one level is really standing out here. One level is standing out here, and that is the $30,000. The $30,000 is a level where we've seen more than 592,000 Bitcoins got accumulated. So a lot of Bitcoins are getting bought up around this region, what means that this is the new standard. Bitcoin, $30,000 is the new standard since so many people are buying around this region. And people are not probably going to sell once Bitcoin goes lower at this point, because if we're also looking at on-chain data, we can currently see balance on exchanges is massively decreasing in a rapid pace, what means that Bitcoin is really seeing the scarcity effect, and over time, less and less Bitcoin will be available to buy, and in exactly like 20 or 30 years from now on, once there's almost going to be no Bitcoin balance on exchanges anymore, it's literally going to be super hard to accumulate even one Bitcoin because it's just so scarce. So we're continuing to see this trend happen even when we're in a bear market, and looking at the addresses with a non-zero balance, we can see it massively increasing, what means that still accumulation is there and there's still adoption and things are still growing. We can see, of course, BlackRock is jumping in towards the markets. So it's just a game of patience. And if you are patient enough, you will be winning. And that is why I love this game. I will be always winning. I will always win because I'm a patient investor. I'm buying Bitcoin like a maniac. I'm buying more and more Bitcoin every single day. And you can see it here with my long trade. With this long trade right here, I'm making it approximately, what is it, $35,000. At some point, it was like $60,000. But I continue to hold this trade here. I am not going to close this trade. I'm not going to do it. My entry price is $25,000. If we go, my liquidation, let me check. My liquidation is around, what is it, $23,000 or $22,000? Oh, no, sorry, $20,000. $20,000 is my liquidation price. So if we hit 21K, I'm just going to add another 2 Bitcoins to this trade. So I am not afraid to be losing. I will be only winning because I'm a patient investor. And if Bitcoin really goes down to 5K, I don't fucking care anymore. But I don't think Bitcoin is going to go down to 5K. I personally think we are closing in towards the end of the bear market. We're really closing in towards the end of the bear market. And maybe Bitcoin can still go down to $20,000. I'm not ruling it out. I'm still counting in. It's still possible. And if that happens, I will just deploy more capital on my swing trades. So extremely excited. And if anyone who's watching this stream right now wants to be trading, you can currently claim a free $1,000 Bitcoin or XRP position. All you need to do is go to the link description, sign up a new account on Bybit, deposit $100. Only $100 within 7 days, and you can claim a free Bitcoin long or short position or an XRP long or short position. So super valuable, and check it out right now in the link description. But yeah, we're 20 minutes out before Jerome Powell is going to start talking, and basically what I want to be saying here is that we are 20 minutes out before real volatility is going to hit the market. So far, volatility has not hit the markets, but yes, this is definitely important to know here. So let me know in the chat, guys. Are you enjoying it? And while you're there in the chat, can you please smash up that like button? Guys, we're in the middle of the bear market. Smash up that like button if you're still here. Only 200 likes, 900 people watching. Can we smash it up to 500 likes? That will be absolutely incredible. Don't forget to smash up that like button. Will be absolutely highly appreciated. You are still sticking around in the bear market, and that is why all these followers that are watching right now are going to be winning. And talking about real winners, I think there's also a lot of money to be making with altcoins. So we can currently see Dogecoin is breaking this downtrend because, yes, like we do know, Elon Musk is doing stuff with Dogecoin. So let me quickly show you this, guys. Probably you already know it. I think if you don't know it, you're really living below a rock. And that is, of course, a thing you shouldn't be doing. But yeah, Elon Musk updated his status towards a D of Dogecoin. And there are a lot of rumors going around that Dogecoin will be a big part in the X ecosystem. And X is, of course, Twitter. So yeah, Dogecoin is moving up here. I think also it's got a lot of potential in the coming bull run. And also, if you're looking at the Bitcoin dominance, what is actually very interesting to be studying, the Bitcoin dominance is running in towards a gigantic resistance, but still people are starting to become very bullish on altcoins, saying, oh, altcoin season is here. And yes, guys, I made a lot of money from altcoins recently, and I will show you guys in a bit. But Bitcoin dominance remains to be in an uptrend. And looking at the Bitcoin dominance and the Bitcoin price action, it moves almost completely similar towards each other. So you can see the candlesticks in the background, that is the Bitcoin price action. And you can see also this line here in this graph, and this line in the graph is the Bitcoin dominance. So Bitcoin dominance moves also almost completely the same as the Bitcoin price action. So if Bitcoin sees a move towards the upside, it is Bitcoin that is leading the rallies. And one thing that you really should be paying attention towards, once the point is going to be happening, that Bitcoin is going to be pumping towards the upside, let's say to $37,000, and the Bitcoin dominance goes down, so it's going to be invertedly, I'm going to turn bearish on Bitcoin. Why? Is because if altcoins are going to lead the rallies already at this point in the market, I personally think we're going to be in for a short-term top in the market. But as long as this is not happening, I remain to be bullish on Bitcoin. And I remain to be expecting that this trend that we can currently see is going to be continuing. So the Bitcoin dominance remains to be bullish, and it remains to be following the Bitcoin price. So Bitcoin is leading every single rally, and altcoins tend to be following after Bitcoin consolidates sideways. And yes, we do know from history, if Bitcoin goes sideways for a while, it usually gives altcoins the room to start to take some market share. And that is exactly what we saw. Well, Bitcoin was so boring, people started to be losing their focus on Bitcoin and went to altcoins. And I don't mind you at all, because altcoins have been making me a ton of money. To be very clear, I've been in one altcoin here, PropChain. I've made a ton of money because I tweeted about PropChain many times before. It's a utility token, a real estate token with a lot of utility. I bought it around this region right here, tweeted about it, and boom, it went up more than 200%. So yeah, I've invested more than $200,000 in this and made literally more than $400,000 in just a time span of an approximately 2 weeks. So there's a lot of money to be making with altcoins, but be very careful. Not every altcoin is going to give you a return, because just like Solana, guys, Solana has seen a massive take up towards the upside. And people are saying, oh, you were so wrong to not be holding Solana, because I'm still not holding Solana. I'm still not a big fan of it. You were so wrong to not hold Solana because it increased an approximately 118%. And what people also said, why don't you hold Solana? Because Solana just went up, let me say this correctly, an approximately 100% against Bitcoin. But I have sold my Solana a long time ago. And while people were buying Solana on the top of the bull run, they maybe are right now still down 81%. Well, in fact, they were down now 89%. So if you bought one Bitcoin, if you converted one Bitcoin in the top of the bull market to Solana, you were holding only 0.1 Bitcoin in the bear market low. And now it doubled. It went up 100%. And you still hold 0.2 Bitcoin. So I am still the bigger winner. And yes, people will always shout and they will always be extremely happy once they make a profit, but probably you don't know the complete story, because the majority of the people, they actually lost money by holding this coin. And congratulations if you did make the money on Solana, if you did bought it on the lows here. But personally, this coin as well, you have to see the trend right here. It is still in a massive downtrend. And as long as it remains to be in a downtrend, I don't remain to be believing that altcoins are really the time to be buying. There's not really the time to be buying altcoins right now. I have learned from my past. Let me go to Cardano, for instance. Let me go to Cardano and let me give you guys a quick analysis here. When was the time to be buying Cardano or any other altcoin out there in the market? And it will be probably the same for the next bull run. Look at how hard Cardano is bleeding against Bitcoin. It is losing so much value. It is in a massive downtrend. Only just a moment ago, it bounced in approximately 40% against Bitcoin, but still ultimately is in a bearish trend. So I remain to be believing that this is not the time to be buying altcoins. And the time to be buying really big in towards altcoins is once Bitcoin is going to be breaking its all-time high. So let me quickly show you this, guys. So Bitcoin broke its all-time high approximately here in November 2020. That was the point you should have been buying altcoins. And this is with almost every single chart. So let me go to Solana's, of course. Let me see, November 2000. Yeah, you can't even see that. Oh, you can see it. So here, November 2020 was right here. This was the point Bitcoin was breaking its all-time high. Perfect time to be stepping in towards this coin. Looking at Ethereum, this is all against Bitcoin valuation. So looking at Ethereum, November 2020, that was this point right here. This was once again a pivotal point in the history. And it was also a very good time to be buying it. And you were taking almost no risk by buying it because, yes, that was really the beginning of the rally for Bitcoin. Bitcoin broke its all-time high. Euphoria ran back in towards the market. So if you want to be a low-risk trader in this market, if you want to be a low-risk trader and you want to make consistent profits, you should be buying altcoins once Bitcoin breaking its all-time high. And to be very clear, I see Ethereum completely different at this point. Ethereum is a different asset. It's becoming so big that it can move invertly against Bitcoin. And you can see also that it is actually holding up against Bitcoin quite strongly compared to all these other coins like Cardano, Solana, all these other coins. So I remain to be expecting that Ethereum is going to be strong. And that is why I'm also buying Ethereum in this bear market. I did do some altcoin buying in the last bear market, but I'm doing it way more into Ethereum this time around because I remain to believe that Ethereum is a strong asset. Excuse me. And if you're also going to be looking at the on-chain data, let me quickly show you this, guys. Many people don't know this. If you're looking at Ethereum, and if you're going to be looking at all the staked Ethereum, so let me quickly, boom, total value staked, boom, let me zoom it out. It is massively increasing the amount of Ethereum that's getting staked. And to be exact here, more than 27 million Ethereum is currently staked. And that is massive because we've gotten approximately, what is the supply of Ethereum? Let me quickly show you this, guys. The supply of Ethereum is 120 million. So approximately 28%, no, not 28, 23% of the total supply, quick maths, is staked at the moment. And that's massive. And it's still in an uptrend. Ethereum remains to be deflationary. I am very bullish on Ethereum, so don't get me wrong. I'm not saying all altcoins are a bad buy right now. I remain to be believing that altcoins are a bad buy in the bear market, and it's only a good buy once Bitcoin breaks above its all-time high. But Ethereum is a different story. Quickly looking as well at Chainlink against Bitcoin, because Chainlink has also been bouncing massively towards the upside. But still, looking at this is the weekly time frame, guys. If you were holding Chainlink the entire bear market, you were down so much here. So Chainlink down on approximately 85%, while it was down 90%. So yeah, small little uptake right here, still in a very big bear market. Well, some people on the internet are saying on Twitter, Chainlink just entered a new bull market. This is not a bull market. This is not a bull market. I love it. I was holding Chainlink. I have been buying Chainlink as well here. I only have a certain amount of altcoins, not a lot. But I do have some of them, because I like the utility. And Chainlink is one of them. So yeah, I was definitely a happy holder. But this is not a bull market of Chainlink. Chainlink is still super bearish, and it remains to be in a bearish trend. So please, do not party too early. Don't spend all your money in the club because you were so happy because Chainlink bounced in approximately, what was it, 60% here towards the upside, 45% against Bitcoin. The big gains are still yet to come. So get ready for that. Make sure to accumulate. Don't spend all your money right now. Try to invest. There's no financial advice. But what I did and why I became so successful in the market is that in the last bear market, I was also buying. And one of the coins I've bought was Chainlink. One of them was Cardano. And also Ethereum. XRP was not necessarily my best decision. But in the bear market, it's time to be accumulating. And if you're accumulating in the bear market, and also Verge was one of my biggest Verge was one of my biggest gainers, but it was in the 2017 bear market. Yeah, this is the time to accumulate, not the time to be laying back here, partying or whatsoever. Let me see what the chat is saying here. Your technical analysis is nothing but impressive. Thank you so much here. 18K incoming. 18K. Who are these people? Guys, I don't believe that we're going to go down to 18K. But of course, anything is possible. Anything. Oh, Bitcoin had a small little uptick. Guys, sorry, I was not paying attention. I was so fascinated about talking about these altcoins. So, that was my brief altcoin analysis. If you want to be seeing me do more altcoins, I can do it. I've got one more crazy altcoin, guys. And it's a very good sim. Let me quickly show you this, guys. This is very important to be looking at. So, let me go to trading field real quickly. I'm going to show you this, guys. This coin right here, Phantom. Is this a buy? Many people are asking me in the chat. Not right now here, but before. I know it's from the bull market. Is it a buy? So this is the Phantom chart against the dollar. Let me put it not on logarithmic. You can see what had happened. So, what a crazy chart. Is this a buy right now? And I can tell you one thing, it is not a buy in my opinion. It is not a buy right now. It is also not bouncing on this most recent bounce. I think Phantom is a dead chain. And I remain to believe this because the Phantom total look value is massively down. Massively. And even recently, it was not last week, but the week before, we saw another huge dump here in the total locked value. So less and less value staked in Phantom. Currently, it's only $66 million. Well, on the top of the bull run, I was extremely bullish on Phantom because more than $7 billion was locked in Phantom. So there was, of course, a small hack, and that was the reason why more value got staked. But yeah, Phantom looks to be a dead chain in my opinion. And what I will be expecting, and I can tell you already, there are more than 10,000 cryptocurrencies right now in the space. And more than 9,000 of them are going to die off. And I think Phantom is another one of these. So if you hold any Phantom, no financial advice, I don't hold anything of it anymore. But I sold all my altcoins in, what was it, July 2022. So this is, some people are saying it as well, it's on Hannah's shoulders. Indeed, it's also a bearish pattern here. But I don't remain to hold any of it, and I personally think it could go way lower since the value is getting lower and lower and lower. So please don't be looking at it. Then I see many people talking about Litecoin. Litecoin currently, of course, if you didn't know it already, Litecoin is going to have a halving in 7 days, I think, right? Yeah, 7 days. We're going to get the next Litecoin halving. Looking at Litecoin, let me quickly go first to the USDT comparison. Looking at Litecoin, we can currently see it's having a move towards the upside. But I remember it from 2019. This is not the right chart. I don't think we've got all the data. Yeah, it was this really right here. 2019, I was in crypto. This was also the last halving in Litecoin. And I think it spiked a few weeks before. Let me see. What was the last Litecoin halving? Oh, I can see it on this chart right here, I think. What was the last past events? I don't know exactly what the last halving was for Litecoin. But I think it was in 2019. And it stopped around... I'm going to quickly search it, guys. Give me 1 second. It happened on the 5th of August. So it happened on the 5th of August. Right here. Boom. Boom. And what are we seeing right now? The halving is going to be happening next week. We're probably going to go down again. We're probably going to go down. Litecoin, am I a big fan of it? I don't know. It didn't really perform that well in the last bull run. Probably it's not going to do in the next bull run as well. Maybe it's going to do. I hold a small little of Litecoin, but it's not a lot. I don't think the big gains are going to be made with Litecoin, and I think the risk is too high. I rather would have Bitcoins than Litecoins, especially at this point. So yeah, not buying Litecoins. Not buying Litecoins. Not at all. Looking quickly at my analysis, I mean, looking at the whole thing, of course, it's going to be bullish, but it's only going to be for the imminent short term. And the real uptake usually happens this time around. It happened like 270 days before, and this one, yeah, approximately 370 days before. And you can even say, okay, it happened from here. It was also 250 days approximately. So Litecoin is done, in my opinion. Would be really buying in towards it right now. Looking at the Bitcoin comparison, you can see since 2018, it only lost value against Bitcoin. So I don't really see a reason to be investing into Litecoin rather than Bitcoin, because it's only losing value in the long term against Bitcoin. And that is not really a trend I should be buying in. Is that crypto rover, Dusty BC? Oh my gosh, is that the Dusty BC who was sitting in my apartment in Dubai last time around? Yeah, that is me, and it's absolutely amazing that you're also here joining the stream, because in exactly 4 minutes from now, we're going to get the Fed meeting where Jerome Powell is going to talk about the markets, and he's going to talk about what is going to be happening next. And yeah, like we do know from the past, let me quickly get the chart in front of the screen, guys. There's going to be massive volatility. So make sure to stick in the stream, smash up that like button if you like the content, share it with your friends, because in exactly 4 minutes, markets are going to be moving back. And it's not only Bitcoin, it's also going to be the classic stock market. So it's going to be very important to be seeing here. So quickly looking into XRP for Dusty BC, because yes, I always do the analysis on XRP for Dusty. Looking at XRP, you can currently see on the weekly time frame, we clearly broke outside of this downward sloping trend line. And if you're zooming out even more, you can see this is somewhat of an historical event. You can see that XRP is once again breaking the downtrend. And you could even say or argue this time here, right here as well, we also saw that massive breakout, and we also had that massive uptick here in the bull run. So yeah, XRP is once again breaking out, looking quite strong here. And if you're looking at the price target of such kind of a pattern, because we literally created a pennant, you can clearly see the price target of this pattern right here. Let me quickly measure it for everyone out there. I will take it a little bit cautiously to here to the upside for XRP is somewhere around $2.90. And since they are not a security, I think they could be doing very well for the next bull run. But like everyone who's following me on Twitter or anywhere else on the channels, on all my other channels, I'm a big fan of XRP, and I expect it's going to be doing very well in the next bull run. What about Polygon? Very big fan of it. I could be talking about it later, but in 3 minutes, we're going to get the FOMC meeting. So let me quickly prepare everything for that as well. Let me open. Let me see. Guys, it's going to be looking a little bit messy, but I will be fixing it. Boom. It looks a little bit messy right now, but I'm going to fix it. So guys, it's going to be starting. I'm going to make it very small for the moment, but I will be making it big in a minute from now on. We'll also enable the sound in a minute from now on. But we still got a few more minutes, guys, before the FOMC meeting starts. So I'm going to be putting this here for a moment. Boom. Yes. So guys, FOMC meeting starts in 2 minutes, and we will be watching it while looking at the price action of Bitcoin. I'm going to also look about what Jerome Powell is going to be saying, and on that I will be reacting and giving my live reaction, looking at the charts, and also try to quote some things what Jerome is going to be saying. So yeah, very important to be paying attention at the moment. But XRP looks quite strong here, especially since they not won the case, but they're not a security. Looking against the Bitcoin pair, you can see that on the monthly time frame so far, we've not seen the breakout against Bitcoin. And also, once again, XRP is different than all the other altcoins. It's like in the same category as Ethereum. Since XRP is moving up against Bitcoin, it's different. This is the monthly time frame. XRP against Bitcoin. It's moving up against Bitcoin on the bigger perspective. So XRP, not necessarily a bad hold. And I wouldn't count it out to be buying it. So I think XRP is a good buy. But I need to go to the Bitcoin chart right now here. Going to be placing it on 1 minute. Oh no, wait, I'm going to keep this one on the 1 hour. Going to place this one here on the 1 minute real quickly. Not this chart, sorry. Let me do this chart, boom. So we're going to be real quickly look at the 1 minute for Bitcoin, because there's probably going to be a lot of volatility. So I'm going to put up my headset. I'm going to fix the sound for you guys out there on the chat. The meeting is going to start. Bro, this sounds very weird, since I'm not very used to talk with a headset anymore. Enable the sounds. Let me see. I need to fix the sound for you guys. Give me 1 second. Should be fixed in moments. Yes, it's fixed. Okay, we're going to be looking at Jerome Powell talking right now. Okay, this is going to be exciting, guys. It's going to be super exciting. Let me make it a little bit bigger. Boom. Jerome Powell on the top side, me on the lower side. What will he be saying? I don't hear anything yet, guys. Sound check.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate a 1/4 percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 1/4 percentage point, bringing the target range to 5.25% to 5.5%. We are also continuing the process of significantly reducing our securities holdings. With today's action, we've raised our policy rate by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Steve.
Mr. Chairman, thank you. You have, I think, a couple times in your opening remarks talked about this language in determining the extent of additional policy firming that may be appropriate. Should we take that to mean that additional hikes are likely on the way? And should we also believe that all future meetings, say September and November, are live, or are you in a every other meeting mode? Thank you.
So we haven't made a decision to go to every other meeting. It's not something we've looked at. We're going to be going meeting by meeting, and as we go into each meeting, we're going to be asking ourselves the same question. So we haven't made any decisions about any future meetings, including the pace at which we'd consider hiking. But we're going to be assessing the need for further tightening that may be appropriate. You read the language, to return inflation to 2% over time. I would say that the intermeeting data came in broadly in line with expectations. Economic activity remained resilient. Job creation remained strong while cooling a bit. And the June CPI report actually came in a bit better than expectations for a change. And the June CPI report, of course, was welcome, but it's only one report, 1 month's data. We hope that inflation will follow a lower path it will be consistent with the CPI reading, but we don't know that, and we're just going to need to see more data. So what are we going to be looking at? Really, it will be the whole broader
Stock
picture.
market is really
starting
moving
with,
up right now.
we're looking for moderate growth, right? We're looking for supply and demand through the economy coming into better balance, including in particular in the labor market. We'll be looking at inflation. And we'll be asking ourselves, does this whole collection of data, do we assess it as suggesting that we need to raise rates further? And if we make that conclusion, then we will go ahead and raise rates. So that's how we're thinking about the next meeting, and how we're thinking about meetings going forward potentially. But we're now mainly thinking about the next meeting. I will also say, since we're talking about it, between now and the September meeting, we get 2 more job reports, 2 more CPI reports. I think we have an ECI report coming later this week, which is Employment Compensation Index, and lots of data on economic activity. All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted, and I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
If I could just briefly follow up on something you said there. You said the data in the intermediate period, it broadly came in line with expectations. Does that mean there's unlikely to have been a change in the overwhelming outlook of the committee that 2 more hikes are necessary?
I'm just going to go back to what I said. That's the question. We have 8 weeks now until the September meeting, and all that data that I recited, we're going to be looking at all of that and making that assessment then. And it really, we did have the one good reading, and of course we welcome that, but it's just one reading, as everybody knows. And we've seen this before in the data. Many forecasts call for rates for inflation to remain low, but we just don't know that until we see the data. So we'll be focusing on that.
Gina.
Thank you. Thanks for taking our questions, Chair Powell. Obviously, you upgraded the language around growth in the statement today. We've seen the Barbie movie numbers. We've seen everyone going to Taylor Swift concerts this summer. It seems like the American consumer is in pretty good shape. And it does seem like growth is sort of picking back up a little bit, or at least doing well. And I wonder, from your perspective, if that continues, if we see growth not just stabilizing, but performing well this summer, is that a problem because it's inflationary, or is it good news because it suggests that a soft landing is more likely? Just how are you thinking about that sort of trajectory?
Yeah, so I would say it this way. The overall resilience of the economy, the fact that we've been able to achieve disinflation so far without any meaningful negative impact on the labor market, the strength of the economy, overall, that's a good thing. It's good to see that, of course. It's also, you see consumer confidence coming up and things like that. That will support activity going forward. But you're right, though. At the margin, stronger growth could lead over time to higher inflation, and that would require an appropriate response from monetary policy. So we'll be watching that carefully and seeing how it evolves over time.
Neil.
Thanks, Chair Powell. Neil Irwin from Axios. So as you referenced earlier, in the intermeeting period, soft CPI, jobs reports, still strong but moderating, JOLTS looks good. So if you're data dependent, why not pause again? Why not stay on hold? Why not take another meeting off when the data was at least cutting in the direction you want to see?
So if you go back to what we're trying to do here, we're trying to achieve a stance of policy that's sufficiently restrictive to bring inflation down to 2%. At the last meeting, we wrote down our individual estimates of what that would take, and the median of that was an additional 2 rate hikes. So I would say we looked at the intermeeting data, and as I mentioned, broadly consistent, not perfectly consistent, but broadly consistent with expectations, and as a result, we went ahead and took another step. And that's, a labor market that continues to be strong, but gradually slowing. I mentioned that the inflation report was actually a little better than expected, but, we're going to be careful about taking too much signal from a single reading. And, growth came in stronger than expected. So that's how we look at it, and so we did take that step today.
Nick.
Nick Tamaros of the Wall Street Journal. Chair Powell, markets widely believe the median FOMC participants' inflation forecast from June for the fourth quarter of this year will be too high, given autos and shelter, and that by September that may warrant a downward revision in the inflation forecast of 20 to 30 basis points. Would that type of inflation progress be enough to hold rates steady from here, or do you need to see below-trend growth and decelerating labor income growth to be convinced that you've done enough?
So it's hard to pick the pieces apart and say, how much of this and how much of that. We'll be looking at everything. And, of course, we'll be looking to see whether the signal from June CPI is replicated or the opposite of replicated, or whether it's somewhere in the middle. We'll be looking at the growth data. We'll be looking at the labor market data very closely, of course, and making an overall judgment about that. It's the totality of the data, I think, but with a particular focus on making progress on inflation.
So Bitcoin is breaking above the range.
Last month you said there were benefits to moderating the pace of increases because it would give you more information to make decisions. Would another CPI report like the one we just had in June allow you to at least maintain that slower pace and defer until the fall any decision on whether you need that second rate hike?
So I'm just going to tell you again what we're going to do in September. We're going to look at 2 additional job reports, 2 additional CPI reports, lots of activity data. And that's what we're going to look at, and we're going to make that decision then. And that decision could mean another hike in September, or it could mean that we decide to maintain at that level. And again, the question we're going to be asking ourselves is the overall signal one that we need to do more, that we need to tighten further? And if we get that signal whenever we get it, then, and that's the collective judgment of the committee, then we will move ahead. If we don't, then we'll have the option of maintaining policy at that level. But it's really dependent so much on the data, and we just don't have it yet.
Chris.
Hi, Chris Rugaber at Associated Press. So consumer confidence in the economy is rising, likely in large part because of the declines in headline inflation. You also see wages are also rising faster than prices now, after trailing them for a long time. How much are Americans truly harmed by inflation at its current level, headline level of 3%? And with that in mind, when do you put some weight back on the employment side of the dual mandate?
So I guess I'd say it this way. First, it is a good thing that headline inflation has come down so much, because that's really what the public experiences. And I would say that having headline inflation move down that much almost creates it will strengthen the broad sense that the public has that inflation is coming down, which will in turn, we hope, help inflation continue to move down. So you are really, sorry, but what your question was?
Well, I mean, you've talked for many press conferences now about the harm created by inflation, how hard it is for people. So how much of that are we still seeing with inflation now down at 3?
So I guess I would put it this way. I'd say it this way. It's really a question of how do you balance the 2 risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not, but as our stances become more restrictive and inflation moderates, we do increasingly face that risk. But, we need to see that inflation is durably down that far. As you know, we think, and most economists think, that core inflation is actually a better signal of where headline inflation is going, because headline inflation is affected greatly by volatile energy and food prices. So we would want core inflation to be coming down, because that's what we think, that's core is signaling where headline's going to go in the future. And core inflation is still pretty elevated. You know, there's reason to think it can come down now, but it's still quite elevated. And so we think we need to stay on task, and we think we're going to need to certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
Well, and then if inflation were to, just a quick follow, if it stays at 3 or drops even a little bit more, I mean, how much of an increase in unemployment do you think is acceptable to get that last bit of inflation? People are talking about the potential difficulty of the so-called last mile of inflation. So, but how much unemployment do you think is justified to get down that last?
So it is a very positive thing that actually the unemployment rate is the same as it was when we lifted off in March of 22 at 3.6%. So that's a real blessing, and that we've been able to achieve some disinflation. And we don't seek to, it's not that we're aiming to raise unemployment, but I would just say the historical record, we have to be honest about the historical record, which does suggest that when central banks go in and slow the economy to bring down inflation, the result tends to be some softening in labor market conditions. And so that is still the likely outcome here. And, you know, we hope that that's as little as possible. We have to be honest that is the likely outcome. The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control, the longer-term social costs of failing to do so are greater, and that the historical record is very, very clear on that. If you go through a period where inflation expectations are not anchored, inflation is volatile, it interferes with people's lives and with economic activity, and you know that's the thing we really need to avoid and will avoid.
Go to Michael McKee.
At this point, you say the policy is restrictive, but all year long we have seen growth surprise to the upside, unemployment to the downside, and inflation lately to the downside. So I'm wondering, by definition, should you be restrictive enough right now under these conditions? Do you think you might need to do more? Because I'm curious about what you see as inflation dynamics now. Is the economy still moving in a direction where it creates more inflation? People talk about base effects and higher energy costs, and now we have some large labor settlements. Or is the economy disinflating, and you're able to go back to the old Fed policy of opportunistic disinflation?
So I'll just say, again, the broader picture of what we want to see is we want to see easing of supply constraints and normalization of pandemic-related distortions to demand and supply. We want to see economic growth running at moderate or modest levels to help ease inflationary pressures. We want to see continued restoration of supply and demand balance, particularly in the labor market, and all of that should lead to declining inflationary pressures. Now, what we see is those pieces of the puzzle coming together, and we're seeing evidence of those things now. But I would say that what our eyes are telling us is that policy has not been restrictive enough for long enough to have its full desired effects. So we intend, again, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate. And we think the process, still probably has a long way to go.
Well, do you think under current conditions you are restrictive enough unless something changes?
Well, I think we think today's rate hike was appropriate, and I think we're going to be looking at the incoming data to inform our decision at the next meeting about is the incoming data telling us that we need to do more, and if it does tell us that collectively, if that's our view, then we will do more.
Colby.
Thank you. Colby Smith with the Financial Times. If September is in fact a live meeting, how does that square with the need for a more gradual tightening pace that you spoke of last month in explaining the rationale for holding the funds rate steady at the June meeting?
So a more gradual pace doesn't go immediately to every other meeting. It could be 2 out of 3 meetings, right? It just means if you're slowing down. The point really was to slow down the decision cycle as we get closer and closer to, we think, our destination. And I wouldn't want to go automatically to every other meeting because I just don't think that's, I think it's not an environment where we want to provide a lot of forward guidance. There's a lot of uncertainty out there. We just want to keep moving at what we think is the right pace. And I do think it makes all the sense in the world to slow down as we now make these finally judged decisions. And so that's what we did. And so I think it's possible, I mentioned before, it's possible that we would move at consecutive meetings. We're not taking that off the table, or we might not. It's really going to depend on what the data tell us. That's the best we can do.
So we shouldn't assume that every other meeting is the lowest tightening frequency, let's say. It could be, longer intervals in between as well.
I think we're going to, look, I think we're going to make a decision about the next meeting, and then we're going to make a decision about the one after that. And I think it'll sort itself out.
Howard.
Thanks. Howard Schneider with Reuters. Among your colleagues, there have been people who've said they feel that very little transmission has taken place so far from monetary policy into the economy, and there are those who feel, they say, it's happened very fast this time and it's kind of up to date. Where are you on that continuum?
So there's a long-running debate about the lags between changes in financial conditions and the response to those changes from economic activity and inflation, right? So we know that in the modern era, financial conditions move in anticipation of our decisions, and that has clearly been the case in this cycle. So in a sense, the clock starts earlier than it used to, but that doesn't necessarily change the process from that point on, and it's not clear that it has. We also, I'll tell you what we know and then what we don't know. We know that financial conditions affect economic activity and inflation with a lag that can be long and variable, or lags, plural, that can be long and variable. A lot of uncertainty around the length of the lags, and by the way, that's just one component of the broader uncertainty that we face. So I'll tell you how I think about this. The first thing to say is we're determined to bring inflation down to 2% over time, and we will use our tools to do that. No one should doubt that. I would look at it this way, though. The real federal funds rate is now in meaningfully positive territory. If you take the nominal federal funds rate, subtract a mainstream estimate of near-term inflation expectations, you get a real federal funds rate that is well above most estimates of the longer-term neutral rate. So I would say monetary policy is restrictive, more so after today's decision, meaning that it is putting downward pressure on economic activity and inflation. We'll keep monetary policy restrictive until we think it's not appropriate to do so. So that's how I think about it. I mean, if I sum it up, I would say we've come a long way. We are resolutely committed to returning inflation to our 2% goal over time. Inflation has repeatedly proved stronger than we and other forecasters have expected. And at some point that may change. We have to be ready to follow the data, and given how far we've come, we can afford to be a little patient as well as resolute as we let this unfold.
On the credit side, I'm wondering if you saw anything in the latest SLOOS data that made you think you're getting a quantum of credit contraction beyond what you'd expect. The bank lending data really is, the growth rates edging down towards and heading below zero, which is usually a recession indicator.
So I guess the SLOOS will come out early next week, and I would just say it's broadly consistent with what you would expect. You've got lending conditions tight and getting a little tighter. You've got weak demand, and it gives a picture of pretty tight credit conditions in the economy. I think it's really hard to tease out how much of that is from this source or that source, but I think what matters is the overall picture is of tight and tightening lending conditions, and that's what this SLOOS will say.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. Could you break down the reasons why inflation has fallen and what share of that credit you would give to factors that don't stem directly from rate hikes or that might be within your control at all, like easing supply chains and a drop in energy prices over the past year?
Yeah. So, interesting question. So, let me start by saying that the inflation surge that we saw in the pandemic resulted from a collision of elevated demand and constrained supply, both of which followed from the unprecedented features of the pandemic and the response from fiscal and monetary policy. And we've always expected that the disinflationary process would stem from the normalization of those broad pandemic-related supply and demand conditions and from restrictive monetary policy, which would help return the balance between supply and demand by restraining demand. And we think that's broadly what what we're seeing. So to go break it down a little further, of course, headline inflation has come down sharply from elevated levels as energy and food prices have come down, mostly due to reversal of the effects from the war in Ukraine. And that's a good thing, and the public experiences that, as I mentioned earlier. For core inflation, I'd say there has been a role for both factors, both that I mentioned. Clearly, for goods, normalization of supply conditions is playing an important role, as is the beginning of the reversal of spending back into services and away from goods. Say, take autos as an example. The combination of an increase in sales and inventories, while vehicle inflation has decelerated, points to a substantial role for supply. But there's also a role for demand, as the loans and things like that are more expensive. So they're both working there. Housing services inflation now starts to move down. Clearly, higher rates have slowed the housing market. I would say monetary policy is working about as we expect, and we think it'll play an important role going forward, in particular in non-housing services, where really we think that's where the labor market will come in as a very, very important factor. So we think both of those sources of disinflation are playing an important role.
See. And just to follow up, do you think that of those two sources, that core will rely more heavily on seeing an impact from rate hikes, or is there a more even split there too?
I think monetary policy is going to be important going forward, because we're sort of reaping now the benefits of the reversal of some of the very specific pandemic things. We're seeing that with goods in particular, with supply chains and shortages moving, and we're seeing. So I think going forward, monetary policy will be important, particularly in the sector, in the non-housing services sector.
Edward. Thank you, Chair Powell. First, let me compliment your tie, the choice of tie. So thanks for taking our question. So the Beige Book, it said, input cost pressures remain elevated for services firms, but eased notably for manufacturing sector. Is that an indication that there's a wage inflation pressure? And how do you target and pressure on the wage inflation without pushing the economy into recession?
Well, I think as it relates to goods, it's really an indication that supply chains and shortages are easing. And so what was the first part of it?
So wage inflation, like how do you target wage inflation without pushing an economy into a recession?
I don't think we're targeting wage inflation. I think what we're looking for is a broad cooling in labor market conditions, and that's what we're seeing. So wages have actually been gradually moving down. They're still at levels that would be consistent over a long period of time with 2% inflation. Nonetheless, we're making progress there. And by so many indicators, labor market demand is cooling. You can look at surveys by workers and businesses who see that. You can look at the quits rate normalizing. You can look at job openings coming down. You can look at just job creation in the establishment survey has, it's still at a high level, but it was at really an extraordinarily high level for most of the last 2 years. So you see cooling, particularly in private sector in the last in the last report. So I think we see that, and it's happening at a gradual pace. So that's actually not a bad thing in a sense, because if what we see is a labor market, very strong demand for labor, which is really the engine of the economy. People are getting hired, many people going back to work, getting wages, spending money, and that's really what's driving the economy. But that it's gradually slowing, it's gradually cooling. That's a good prescription for getting where we want to get.
But still, we see a push to raise minimum wage. We're seeing a lot of unions go on strike or threaten strike, and the common thing is they come out with agreements like big pay increases, like UPS, and we have the auto workers coming up. Are you concerned then about a trend of series of big unions, these contract pushing wage inflation then?
Not for us to comment on contract negotiations. Not our job, not our role. We monitor these things, and we'll keep an eye on them. But really, that's something that's handled at that level. And not
a large amount of people.
Victoria. Hi, Victoria Guido with Politico. I wanted to ask about the SEP, which suggests that you would cut rates as overall and core PCE get to around or under 3%. And so I'm wondering, is the level of inflation what's sort of important there as you think about getting to 2% and when you might start cutting rates, or is the speed at which inflation is falling also important?
I think you'd take both into account. I think you take everything into account when you start cutting rates. It would depend on a wide range of things. And when people are writing down rate cuts next year, you know, it just is a sense that inflation is coming down and we're comfortable that it's coming down and it's time to start cutting rates. I think, but I mean, there's a lot of uncertainty between what happens, you know, in the next meeting cycle, let alone the next year, let alone the year after that. So it's hard to say exactly what happens there, what's motivating people.
So if it's sort of stubbornly in maybe the high twos, you wouldn't necessarily cut rates.
I'm not saying that at all. I'm not giving you any numerical guidance around that. I'm saying we'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year, I don't think. It would be, you know, many people wrote down rate cuts for next year. I think the median was several for next year, and that's just going to be a judgment that we have to make then, a full year from now, and it'll be about how confident we are that inflation is in fact coming down to our 2% goal.
A good part of Wall Street has become more confident that the Fed is going to be able to engineer a soft landing, and they've reduced their forecast for a recession. And I'm wondering if the staff has changed its view on the likelihood of a recession being likely, and if you personally have changed your view in terms of becoming more confident that you can achieve a soft landing.
So it has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view. And I think, you know, that's sort of consistent with what I see today. So, but it's a long way from assured, and you know, we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast, but given the resilience of the economy recently, they are no longer forecasting a recession. I just want to note that that our staff produces its own forecast, which is independent of the forecast that we, as FOMC participants, produce. Having an independent staff forecast, as well as the individual participant forecast, is really a strength of our process. There's just a lot of, I think, constructive diversity of opinion that helps us make, informs our deliberations, helps us make, I hope, better decisions.
And is the reason for optimism that inflation has come down and you still have a strong labor market? I mean, does that add to the optimism?
I wouldn't use the term optimism about this yet. I would say, though, that there's a pathway. And yes, that's a good way to think about it. We've seen so far the beginnings of disinflation without any real costs in the labor market, and that's a really good thing. I would just also say the historical record suggests that there's very likely to be some softening in labor market conditions, and consistent with having a soft landing, you would have some softening in labor market conditions, and that's still likely as we go forward with this process. But it's a good thing to date that we haven't really seen that. We've seen softening through not through unemployment, not through higher unemployment. We've seen softening through you know, job openings coming down part of the way back to more normal levels. The quits rate, so people are not quitting as much. We've seen participation, people coming in, and so labor supply has improved, which has lowered the temperature in the labor market, which was quite overheated, you know, going back a year or so. So we're seeing that kind of cooling, and that's very healthy, and you know, we hope it continues.
Jeff. Thank you, Mr. Chairman. Jeff Cox from CNBC.com. You and other Fed officials in the past have suggested that you don't need to keep hiking until inflation hits 2%, that as long as you see continued progress. So I'm wondering, how close do you need to get with the inflation numbers coming down? How many months of data do you need to see that will give you sufficient confidence? And you know, how far does this fight need to go before you're willing to kind of declare victory on it?
So the idea that we would keep hiking until inflation gets to 2%, it would be a prescription of going way past the target. That's clearly not the appropriate way to think about it. So, in effect, if you look at our forecasts, the median participant, and again, these are forecasting out years, so take them with a grain of salt, but people are cutting rates next year because the federal funds rate is at a restrictive level now. So if we see inflation coming down credibly, sustainably, then we don't need to be at a restrictive level anymore. We can move back to a neutral level, and then below a neutral level at a certain point. I think we of course would be very careful about that. We'd really want to be sure that inflation is coming down in a sustainable level. And it's hard to make. I'm not going to try to make a numerical assessment of when and where that would be, but that's the way I would think about it. Is you'd stop raising long before you got to 2% inflation, and you'd start cutting before you got to 2% inflation too, because we don't see ourselves getting to 2% inflation until all the way back to 2 until 2025 or so. So.
Okay, that could maybe cause the markets to yeah.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. It's been over 4 months since a handful of regional banks, including Silicon Valley Bank, failed. When you look at credit conditions now, given Bank of California's acquisition of PacWest, does this acquisition suggest the full impact has not been felt, or are you comfortable saying that we've seen most of the ripple effects that may have occurred at this point, and how does this play into your outlook for policy?
So I don't want to comment on any particular merger proposal, but I will say things have settled down for sure out there. Deposit flows have stabilized, capital and liquidity remain strong, aggregate bank lending was stable quarter over quarter and is up significantly year over year. Banking sector profits generally are coming in strong this quarter, and overall the banking system remains strong and resilient. Of course, we're still watching the situation carefully and monitoring conditions in the banking sector. In terms of the actual effect on, if you think of a particular set of banks that were affected because of their size and business model and things like that, that were more affected by the turmoil in March than others, it's very hard, as I mentioned, it's very hard to sort of tease out the effects on this very large economy of ours from them tightening. They may be tightening a little bit more, probably are, than other banks. The SLOOS has been telling us for more than a year that banking conditions are tightening. That process is ongoing, and that will restrain economic growth. So I think we have to take a step back from. I can't separate those anymore. I think basically we're just looking at the overall picture, which is one of tightening credit conditions, and that's going to restrain economic activity. It is restraining economic activity. So that's how I would look at it.
And how is that informing your outlook for setting policy?
So I think that is an expected result of tightening interest rate policy, is that bank credit conditions bank lending conditions would tighten as well. And so the question is it more effective this time because of what happened in May? I just don't think we know that. I think we're looking at the current data in GDP, and we're seeing strong spending. We're seeing a strong economy, and it's made us confident that we can go ahead and raise interest rates now for the third time since the March events. It seems like the economy is weathering this well, but of course we're watching it carefully and expect to continue to do that.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I wondered on wages if you were at all concerned about any inflationary impact of wages now outpacing inflation, which is likely contributing to the boost in consumer sentiment and the continued strength of the consumer that we've been seeing.
Well, wages in excess of inflation means real wages are positive. Again, that's a great thing. Of course, we want that. We want people to have real wages, but we want wages to be going up at a level that's consistent with 2% inflation over time. As I mentioned, nominal wages have been coming down gradually, and that's what we want to see. We expect to see more of that. That's just more of what's consistent over a longer period of time. We don't really think that wages were an important cause of inflation in the first year or so of the outbreak, but I would say that wages are probably an important issue going forward. Labor market conditions broadly are going to be an important part of getting inflation back down, and that's why we think we need some further softening in labor market conditions.
This goes sort of to the balance of risks question, but you mentioned at the start how you're keeping an eye on consumer activity and whether there might be some sort of a rebound there. And I'm curious what the Fed's explanation would be to families if further interest rate hikes start to hit the labor market, start to drive that sentiment back down. What's the message there of why you continue to keep rates elevated or to raise them?
Well, we have a job assigned to us by Congress to get inflation under control. And we think the single most important thing we can do to benefit those very families, especially families at the lower end of the income spectrum, is to get inflation sustainably under control and restore price stability. We think that is the most important thing we can do now, and we're determined to do that. And I would just point out that the people who are the most hurt by inflation right away are people who are on a low fixed income, who, when you're talking about travel or transportation costs, heating costs, clothing, food, things like that, those, if you're just making it through each month on your paycheck and prices go up, you're in trouble right away. Even middle class people have some resources and can absorb inflation. People in the lower end of the income spectrum have a harder time doing that. So we need to get this done, and the record is clear that if we take too long or if we don't succeed, that the pain will only be greater. So that's how I would explain what we're doing.
Thank you, Chair Powell. Simon Urbanovich with The Economist. You had said last month that this meeting this week was going to be a live one. In the event the market had assigned a roughly 99% probability to the rate move that you announced today, the decision was, of course, unanimous, and the statement was basically unchanged from last month. So may I ask, to what extent was the meeting actually a live one? Was there ever any doubt over the past 2 days about what the decision was actually going to be?
Well, was there doubt? Look, I would say there's a range of views on the committee, and when you see the minutes in 3 weeks, you'll see that. There's a range of views about what we should do at this meeting and what we should do at the next meeting, and it's a process that we go through. Many times when we go into a meeting, the decision is not, fundamentally in doubt. Nonetheless, we have the meeting, and some meetings are less uncertain than others, and I'll just leave it at that.
Evan Reiser, Market News International. Thank you, Chair Powell. Financial conditions have been loosening at a fairly steady clip in recent weeks, the dollar, the stock market, et cetera. What does that mean for the Fed in being sure that inflation will come down to target?
So we monitor, of course, financial conditions, broad financial conditions. You're right, it's the dollar and equities, and we're of course very focused on rates and our own policy. We're going to use our policy tools to working through financial conditions to get inflation under control. The implication is, we will do what it takes to get inflation down, and in principle, that could mean that if financial conditions get looser, we have to do more. But what tends to happen, though, is financial conditions get in and out of alignment with what we're doing, and ultimately, over time, we get where we need to go.
If I could also ask about the SEP from June that showed rate cuts. Do you expect the Fed to cut nominal rates next year while also continuing QT?
So that could happen. The question is, is that consistent with? So if you think about both of them as normalization, imagine it's a world where things are okay, and it's time to bring rates down from what are restrictive levels to more normal levels. Normalization in the case of the balance sheet would be to reduce QT, so to continue it. You depending on where you are in the cycle. So there are two independent things, and really the active tool of monetary policy is rates. But you can imagine circumstances in which it would be appropriate to have them working in what might be seen to be just different ways, but that wouldn't be the case.
Let's go to Kyle.
Thanks, Chair Powell. Kyle Campbell with American Banker. I have a question about the discount window.
And I'm wondering if since the bank failures of the spring, if you've seen signs that banks have taken more steps to be proactive in assuring that they're ready to use that facility if they need to. And if you have any sort of thoughts on whether policies might be appropriate for making sure that banks sort of test regularly to show that they are prepared to use it. Thanks.
So that's a very important thing, yes, and yes to both sides of that. You know, yes, banks are now working to see that they are ready to use the discount window, and we are strongly encouraging them to do that, banks broadly. We did find, as you know, during the events of March, and that that it's a little clunkier. It can be a little clunkier and not as quick as it needs to be sometimes. So why not be in a situation where you're just much more ready in case you need to access the discount window?
Let's go to Mark. Henry?
Mr. Chairman, Mark Hamrick with Bankrate. You've talked in the past about getting the housing market back into better balance, excuse me, and also that the market might have bottomed. Where do you see that situation and balance, or lack thereof, right now, particularly with the constrained inventory of existing homes that might otherwise be coming onto market at a time when existing homeowners are reluctant to move? And of course, all of that happening with the 30-year fixed-rate mortgage still around 7% on the heels of Fed tightening, and with what you're talking about, tightening industry lending standards. Are we getting closer to balance or farther away? What's your sense?
I think we've got a ways to go to get back to balance, really for the reasons that you talked about. With existing homes, there are many people who have low-rate mortgages, and whereas they might want to sell in a normal situation, they're not going to because they have so much value in their mortgage, which means that supply of existing homes is really, really tight, which is keeping prices up. On the other hand, there's a lot of supply coming online now, and there are people coming in. A lot of the buyers are first-time buyers coming in at buying it with these relatively elevated mortgage rates. But I think this will take some time to work through. Hopefully more supply comes online, and we work through it. We're still living through the the aftermath of the pandemic.
We'll go to Nancy for the last question.
Last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Russia has pulled out of an agreement allowing shipments of grain safe passage through the Black Sea, and alternative routes at this point could be closed off. Just wondering, how could that contribute to higher food prices and inflation generally, and how closely are you watching that?
We are watching it, of course, very closely. And you're right, the withdrawal from the Black Sea Grain Initiative does raise concerns about global food security, particularly for poorer countries that import a large share of their food. Grain prices did go up on this news, but they remain well below their peaks of last spring. And the moves that we've seen so far, I would say, are not expected to make a significant contribution to U.S. inflation. Of course, we will be watching that situation carefully.
So you don't think it would have a big effect on Fed policy at this point?
You wouldn't say so, looking at what we know now.
Thank you.
Thanks very much.
Okay, that was it. That was the FOMC meeting, guys. Very interesting to be watching. In the end of the day, what happened with Bitcoin? Not a lot. But straight away before you leave, I will explain to you guys what usually happens after the FOMC meeting. Because yes, let me put off my headset real quickly. While we had this meeting, some very interesting things happened. First of all, some interesting things happened, what Jerome Powell said. And of course, probably in 2024, we're going to see the rate cuts, and we're not going to see them in 2023. But that was already a thing that we did know. But looking at Bitcoin real quickly, what really changed up right here is that while we had the FOMC meeting, Bitcoin spiked towards the upside, came down again, and at the same time, open interest increased, while in fact, the funding rates only became lower. So what we're seeing right now is that many people are loading up short positions, what actually makes me quite bullish. Because, yeah, if people open up shorts on a low like $29,000, it could mean that we're going to get a short squeeze. So yes, we are seeing open interest increase while Bitcoin remains to be quite low. So that is very interesting, and the funding rates are extremely negative right now at the moment. And to be very clear, if an FOMC meeting happens, sometimes we see a lot of volatility on the meeting itself, but some other times we tend to see a lot of volatility after the meeting. So Zooming out, you can see here, we had big volatility after the meeting, big volatility after the meeting, big volatility after the meeting. Here, not really. Here, we did saw a huge dump towards the downside after the meeting. And also after the last meeting, we saw a big rally towards the upside. So what is it going to be this time around? Of course, you want to have the answer, but currently, I do not have the answer on that question. I mean, if we are going to be looking about what is going to be happening next, we're expecting this is the last interest rate hike. So it could mean that we're going to see, due to that, another move towards the upside, because the last meeting we saw a pause, and due to that, we also moved towards the upside. So yes, very interesting to be looking at. The S&P 500 remains to be very resilient, trading around the same level, not really moving all too big. But looking at the S&P 500 and the classic stock market, on the last 3 meetings, we had a move towards the upside in the following week and the week itself after the meeting occurs. So, I mean, I don't really see a reason why this trend won't continue, right? It could be different this time around, but it looks to be that every single meeting the market moves up. Then also Jerome Powell said that they will be looking at the incoming data. So it's going to be super important to look at the inflation data in the coming 2 months, because yes, the next FOMC meeting isn't just from 2 months from now on. So yeah, it's going to be very important to be looking at that. So the inflation data is going to be having more impact than usual probably on the markets. So make sure to keep your eyes wide on that. I will be also live stream these events on the market. And yes, these events are even a little bit more volatile. That's the right word for it. So looking at core inflation, Jerome Powell also said core inflation is the most important thing to be looking at. So looking at core inflation, currently around 4.8%, currently around 4.8%, expecting to be dropping to 4.6. So if this really comes in lower than expected, we'll be very bullish for markets. So I'm going to be looking at that, but that will be happening at the 10th of August. So we have to be a little bit more patient about that here. Bitcoin remains to be very boring, remains to be trading around this level. What is important to be knowing here is that currently Bitcoin is trading above this range high. So I talked about this. Previous resistance could be flipping into support right now. So Bitcoin actually on the imminent short term, not looking all too bad. And I mean, really the next resistance is 29.6K. So if I go offline, I am not live, and Bitcoin moves up here, and it really moves in towards that 29.6K region. That is really the region where I will be expecting a big resistance and big rejections from. So make sure to keep your eyes wide open on that. Yeah, I mean, for Bitcoin, we can currently clearly see, like I said in the beginning, a lot of shorts are getting open. So we could start to see potentially short squeeze happen. And I mean, well, I've been talking about that, Bitcoin is moving up again, so maybe it could be happening right now. But make sure to pay attention towards this. Make sure to keep this in account. And of course, Bitcoin not decide to be breaking down right now. Could be happening later today, of course, but remains to be trading in a falling wedge here. If you want to be seeing the price target, go to the beginning of the video. And also quickly, I want to say to everyone who's watching right now, there's a very big opportunity. Go to cryptocurrencies.com. Trading algorithm has been live since the midpoint of 2022. If you struggle with trading Bitcoin, with buying it in bear markets, with selling it in bull markets, CryptoC is for you, because CryptoC is a trading algorithm that completely does everything for you, helps you to make more money in the bull run, helps you to make more money in the bear market. Go to cryptocurrencies.com. You can find also in the link description. It's a trading bot. It completely does everything for you. It's super valuable, and it's a premium trading algorithm designed through AI, and also keeps self-improving, so it's going to be making better trades in the future. So, and like you can see, these are the results. You can download all the transparent data on the website. Go to cryptocurrencies.com if you want to really enhance your crypto trading, and especially if you really want to make tons of money in the next bull run. And if you learned from the last bull run and said, okay, in the last bull run my struggle was not to take enough profits, CryptoC is definitely for you. And if your struggle also is, in the last bear market, I didn't bought enough around 16K, CryptoC is also for you, because it buys and sells without emotion. So, I mean, Bitcoin, that was it. Not really moving all too much here. I gave all the information. Make sure to subscribe to the channel right now, because tomorrow in the morning, so in approximately 12 hours from now on, I will be updating you guys again on my YouTube channel. I will give you guys a brief update about what happened next year. So subscribe to the channel with the bell notification enabled. If any more important news or data is going to come out, I will be jumping back live again here. But anyways, thank you so much for watching towards the amazing new stream here on the channel. There's the camera. I forgot. Here's my screen where I can see myself, but here's the camera. So guys, thank you so much for watching towards this amazing new video here on the channel. It was an absolutely lovely live stream, and I'll see you guys back tomorrow on the new update video. Peace out. Goodbye.